Hedge Fund Lion's Den, brought to you by Eurex Group.
Two emerging managers enter the den and face the interrogation of the lions. At stake, a potential total allocation of $75 million. Each manager has only 2 minutes to pitch their strategy, followed by one-to-one meetings of 20 minutes with each of the lions before returning to the den to discover their fate. Now it's time to meet the players.
I am Andrew McCaffrey. I'm Global Head of Alternatives at Aberdeen Asset Management. So the first 20 years of my career were in investment banking, mainly in trading and sales in the fixed income derivative area. I then moved into fund of funds as my first entry in 2003. Following on from that activity both at Aberdeen and then at Bluecrest, in actually managing money in fixed income and multi-asset related strategies, and then to Aberdeen, where we've set up the alternatives division that I now run.
My name is Natasha Reeve-Gray. I'm a principal and founder of Altis Partners. I have a nearly 20-year career in managed futures, ranging from brokerage, trading, through to now being a principal and founder obviously of Altis and running the strategic direction of the firm and the business development. You can punch in essence way above your weight if you are very well organised, very well presented. By that I mean materials, the way you present yourself, your messaging, being very clear about what you do. Materials are important because you can actually look far more institutional and have a higher calibre, if you like, in the investor eye if you can really differentiate yourself that way. So I think you can actually be even for an emerging manager, quite impressive with low asset. I think you also need a game plan. I think it's really important that you have a strategic view on how you're going to develop the firm. And a lot of investors will want to see that because you cannot tick all the boxes from day one.
I'm Ewan Kirk. I'm the founder and chief investment officer of Cantab Capital Partners, a systematic hedge fund based in Cambridge. I started my career as an academic. I have a PhD in astrophysics and general relativity. I went to the dark side and joined Goldman Sachs in 1992, and I left there as a partner in 2005. And following that, I started Cantab Capital Partners. In terms of advice that I'd give to people trying to start a firm like mine, I mean, the first advice I'd give them is it's a very difficult task. You're going to have to invest a lot, not just emotionally but financially, in just getting to the point where you might credibly ask somebody for money. You've got to be enthusiastic about what you do. You've got to really love it. You've got to live it. It's very difficult for small managers to become big. To grow large, you have to be credible to large investors. And that is a much wider thing than just having a good model. It's having great risk controls, it's having great execution, it's having a good research framework, it's having technology, it's having operations, finance, legal, all of those things. I don't wish to say back office, but it's one of the things that they really look for. For us as an industry, the future is about continuing to do what we do. Invest in research, technology, build the best strategies we can, build the best risk management tools we can, and build the best alpha sources that we can. I work with smart, bright, creative people every single day. And in addition, there are lots of very hard problems. And to some extent, my career has been about solving hard problems, sometimes failing to solve them, sometimes solving them, but just thinking about hard problems. And I get to think about hard problems every single day, and that's an absolute joy.
I am Richard Edwards, founder and principal of Hedge Capital. I studied mathematics and law at Cambridge and then ended up working in financial markets after a brief period in civil engineering. I left the financial industry to start HED just after the end of the Cold War to take advantage of the shifts that I could see coming globally at that time. And my particular interest, and the company's focus now, is on crowd behavior. Crowd behavior, we think, holds the clue to market movements. When we started this, we thought that there were two things that we could possibly do. One would be to analyze value in the way that Warren Buffett and so many other great investors have done. But the thing that we thought that we were best at was looking at crowd behavior, because it's crowds that move markets.
I'm Patrick Boyle, a founding partner of Palomar Capital Management, a UK-based CTA. I've been working for 16 years in the asset management industry. I started out my hedge fund career working for Victor Niederhofer. I moved on to work for large hedge funds like Millennium for Izzy Englander. I worked at large banks like RBS and Nomura, and roughly 2 years ago launched Palomar Fund. I started a hedge fund because I had worked for years in this industry alongside numerous other traders trading different strategies, and realized that my style of trading was totally uncorrelated with a lot of the other strategies that I saw. My trading philosophy is to analyze data using scientific principles in order to try to understand how markets move and to try and find behavioral influences within markets. I really just want to build a good business with happy employees, with happy customers, and I want to achieve the kind of returns profile that I think is attractive to investors and that's not available elsewhere in the marketplace. One of the greatest challenges was just even working out what it was that, how to structure a fund, what partners to deal with, which brokers you wanted to deal with, which administrator, which auditor. I hope in a year's time to have a great track record, to be able to pitch, and also to have the right institutional infrastructure in place such that these investors are happy to invest with us. It's exciting to me to sit down and do research and learn more about how markets work and to improve what I do. And so that's what drives me, and that's what makes me interested in my job every day.
Good afternoon. 20 years ago, feedback was a hot topic in market circles, as people thought it might offer some explanation as to why some market trends become self-sustaining, which is of course the big question. George Soros claimed to have invented the whole thing, and there was good general interest, which waned when people found it more difficult to use than to understand. Our group took an interest at the same time because we were exasperated with existing market tools, and we persevered with it. And after many years of work and a little bit of luck, we came up with several different ways using those techniques to predict what might happen to market prices, mostly by measuring mood, as explained in our videos. Results of this were very good, surprisingly good, but we felt that we should explain this to people by demonstration because the methods were unusual. In May last year, we broadened our focus to add and increase the number of trades from all markets. And that program, which with adding in some trading rules and some risk management rules as well, which we felt were necessary. And that program has returned 23% with small losses along the way, and that's the one that we now invite fresh investors into. This whole process has been open, so our entries and exits have all been publicly posted. Both of the track records, the 7-year S&P only track record and the shorter all markets track record, have come from, have built in real time from publicly posted trades, so there's been no backtesting whatsoever. So we've proved ourselves in the full glare of public view, and at some considerable cost, foregone revenues and careers. So in order to build the business from now on, we feel that we have to manage money in a more conventional manner, just in order to capture the usual rewards for generating alpha. And so open source is a charming idea, but it's not a particularly good business model for hedge funds. So now we feel we must withdraw a little bit in order to work more and better for our investors and for ourselves. Thank you.
Where would you categorize yourselves?
I think that we're tactical and opportunistic, and very probably should be best categorized as a CTA, commodity trading advisor, because all our trades are in futures. Our average holding period is about 15 days, so that would suit people who like that time frame.
But it's not systematic in that sense.
The exits are all systematized, and the entries are, I would say, 60% systematized. So
it's a bit like pregnancy. You either are or you aren't.
Well, except that we are, if you like, therefore a little bit pregnant. Our systems generate ideas, which then a human being scrutinizes and either rejects or accepts.
Tell me a little bit about the risk management. You mentioned you put some rules around. So what does that consist of?
The trading rules are mostly because we expanded our reach. So when we were concentrating on equity markets, because that's what our readers wanted, we pretty much always had a view. So there's so much information about the US stock market and European stock markets and so on, so many different data streams, instruments that we can analyze, that we were almost never lost to a view. And so a very simple set of risk management tools was perfect for that, was suitable for that, just stops, essentially. Broadening it out to commodities, currencies, and bonds, we've always followed those, but we increased the number of trades in those markets over the last year. We don't always get an exit. We don't always have a view. And so therefore we needed some help from rules. Mostly that was risk. So we calculate the position sizes based on the relative volatility of the market. More volatile, we take a smaller position. Less volatile, we take a slightly larger position. It's not linear. And then we place a stop according to the financial risk that we want to take on that trade. So the stop is always a financial constant, but a variable price distance away.
What is it that you're really trying to appeal to, given that that is going to limit the number of investors who can consider you at this stage?
I'm sure we won't appeal to everybody. In fact, we might even not appeal to that many people. But we offer performance. We offer relatively unvolatile performance.
And what are the other people's appetite for this in your group? I mean, they're all focused on getting, you all want
They're
the same thing.
enthusiastic.
Thank you very much for taking the time to meet with me. My name is Patrick Boyle. I'm a co-founder of Palomar Capital Management, a quantitative hedge fund launched in 2012. Palomar's core investment philosophy is to build quantitative strategies around persistent and understandable market behaviors. Our goal is to provide clients with steady, low volatility returns that are uncorrelated to the markets we invest in, and equally that are not correlated to other hedge funds in our space. We have a track record going back to 2007 with returns of over 9% a year annualized. We have volatility lower than quarter of the S&P 500 with a Sharpe greater than 2. I have over 16 years of investment management experience. I have worked at large investment banks and hedge funds, and I started my hedge fund career working for Victor Niederhofer, a former partner of George Soros. My partner, Jesse, has over 9 years quantitative trading experience, 5 years of which was spent in the proprietary trading desk at Barclays Capital. We have invested over 80% of our net worth in the fund. We have attracted a global investor base of quantitative fund specialists. We're based in London and FCA regulated, and our fees are 1 in 10 for early investors, and that share class is open at the moment. And I would like to ask you to consider investing in our fund. Thank you.
Can you just quickly run us through what exactly it is that you do trade in the portfolio, and also what are the other things that you are considering instrument-wise, market-wise, that you could add over time?
At the moment, we trade equity index futures in Europe and in the United States. So we look to invest in the most liquid global futures contracts. We don't invest at all in emerging markets. The next move will be into fixed income contracts, things like the US Treasury bond and the Bund. And there is a lot of room for us to expand our trading universe within developed market liquid futures.
How would you categorise yourself in terms of the strategy? Where would you put yourself?
I guess we would classify ourselves as a short-term quantitative futures trading fund. So we have probably a shorter time horizon than a lot of the big funds that are out there. And we look for sort of signals that would give us an average holding period of 1 to 3 days usually.
That may cause you problems with capacity. It's a very hard thing to model costs.
It is, yeah.
Do you have any feel for capacity?
At the moment, we've managed over 100 million in previous roles in which I've worked without really having any market impact. We think that we could easily manage $1 billion. That would involve adding a few additional contracts, but we would be very small within the markets that we trade.
Feels like you've sort of already got a successful hedge fund. What are the obstacles? in getting to 100 million, 200 million, 500 million.
Time and good returns should hopefully bring us there, but equally we are in a process right now of trying to grow the infrastructure.
What market environment really suits your strategy, and what market environment does it not do so well in?
We've tended to do quite well in most market environments. In recent months, we've had a little bit of difficulty just with the extremely low volatility.
What we do. Nobody does exactly what we do. We have gone down an unexplored alley.
And everyone says that.
Well, maybe that they will say it, but in our case it's true.
Great, good. But if you're not going to market, how's anyone ever going to know about that?
Oh, but we do have a full marketing plan. It's just that we are at the very beginnings of it right now.
Okay. Well, I'd like to see the other material, because certainly the material I've seen, and I'm not entirely sure that a YouTube video really...
Vimeo.
Whichever.
It's like YouTube, but without cats.
Yes, I do know what Vimeo is. The serious point here is I don't think an online video is really the right way to think about marketing your fund.
We're hoping that our videos are going to be ambassadors for us, because they do explain what we do, because it is quite complicated to explain face to face from a cold start how it is that we have come up with a set of metrics for mood. And how that differs from measuring opinion, because of course the heart and the head are different, and it's the heart that rules many decisions.
And then, of course, you're going to have to come up with something which is a suitable product. Now,
we have that.
You believe you have it.
Yes.
I've read your marketing materials. I don't believe you've got it.
Have you seen our video?
Yes. I still don't believe you've got it.
Did you like it?
Not really.
Really?
No.
You had tried to explain it in a layman fashion, which I think is really important, as opposed to baffle people with science.
Well, we're so quanty that we don't want to come across as impenetrable geeks.
No.
You know, the interesting part, hopefully, for you is and this is where I would try and draw out, is the degree to which return profile can be entirely diversifying and uncorrelated to many of your peers, whoever those peers one would frame, but also to many of the categories that you might be put into. And that's where maybe some work to be done.
Well, we've compared ourselves only with CTAs there.
Yes, and I think that's a bit limiting.
Yeah.
So
where are you with assets now?
we're just over $50 million.
Okay, well that's great.
Right now,
and that's the majority of that, I presume, the new clients, basically.
Yes, yeah.
That's great.
Yeah,
that's
and
great.
it's mostly in managed accounts.
Given your strategy and the performance of your strategy, it seems like it's almost, with a realized Sharpe ratio of 2.9, why would you bother having investors at all?
There's plenty of scalability is really the issue. It's our holding period is on average sort of 2 to 3 days in the most liquid markets in the world. It's big contracts like the S&Ps.
But then again, you've got to have a large enough edge to trade that kind of higher frequency trading. It's very hard to scale.
Yes, I think, well, we in our offering documents, we actually capped the size of the fund to start with.
When I read it and listening to you discuss, if I'm honest, there's elements of DeMark all over this.
I've never looked at anything DeMark has written. Fundamental analysis is always a little bit behind the curve. Technical analysis we distrusted because it doesn't give you the top, it doesn't give you the bottom, and often there's no middle. And so we thought the only two things that might work were value investing, which is too long term for my taste, and sentiment. That is the mood of the crowd, which actually moves the market through stimulating buying and selling. So we set out to measure the mood of the crowd. And that's why we lit upon Hurst exponents, because that mood trend is a very good proxy for mood.
We started off giving an information document that was very much detailed and tried to explain everything in very layman's speak, because of course you'll have the problem that when you describe a technique to some person, whether it's in the US or over here, they'll think it's another thing because one technique can be thought of in a different way. So that did us a lot of favours early on. So I think it's important to have a document that you can read, that you can also brand and make it look professional as well, because people will take notice. The trick is also really knowing who you're going in to see, that they're going to be receptive and it's the right thing for them. I think often we made the mistake in our past of perhaps just being so excited about what we were doing and knowing that it was great.
That's us.
That we didn't really listen, and we didn't sort of try and categorise who we were seeing effectively enough. So we were actually not wasting our time with the wrong people, if that makes any sense. When you get a failed meeting, you know, don't be afraid of going and asking.
Yeah.
They may not tell you.
Well, I guess if they're not going to invest anyhow, you might as well ask them
Well,
why.
and ask them why. You know, it's important. And sometimes they won't know. Often it'll be because they have to go with the bigger player.
Yeah.
And they may not be able to tell you that.
Yeah.
But it's worth helping you really work out your message and how to position yourself. It's not just the investment risk, it's the manager risk.
Yes, yeah.
And they want you to be around if they've chosen you in a portfolio to actually survive.
Yeah, the only way people can shut my fund down is if they convince me to pull out of it. So.
Yeah, well that's good. That's a good line. Use that often.
What you don't have is a way of conveying that believably to other people.
Ah, so you think it's a question of sales and marketing?
Everything's a question of sales and marketing, Richard.
You see, I'm a firm believer in the virtue of content.
Well, there we go.
As a business, we started out about 2 years ago, and our real goal was just to set it up, build a track record, and manage our own money.
Right.
And so we had a setup that you know, was in line with that. So we didn't overspend on huge office spaces, or you know, we decided to build everything in an appropriate manner. Now, was it difficult, I guess, transitioning from managing a small amount to a large amount of money? Because obviously staff would have to grow.
Yeah, what was probably the most challenging was trying to hire the right people.
Yes.
Because we weren't experienced in sort of, that's not our forte. Our forte was running money and trading. So that was a live and learn process. I think spend an awful lot of time trying to figure out your culture.
You are a professional risk taker.
Yeah.
But the one risk you haven't taken is to go out and hire 10 people.
Yeah.
And pay for them yourself.
Yeah.
Put your own money on the line and build a business. You're not going to be able to build it organically.
Yeah.
You know, we had approximately 15 employees for nearly 9 months, basically with no assets. And that costs a lot of money.
Yes. Yeah.
And unlike losses in the fund, that money comes straight out of your pocket. You're not getting it back if the firm fails.
Yeah.
Right? If your fund fails, you invest your net personal worth in your fund and it fails, it's probably failed because it's gone down by 20%, 30%. You've still got 70% of your money. Whatever you spend in starting
when it goes
the firm,
in salaries.
when it goes in salaries, it's gone out of the door. So, but you've got to take that risk.
There's 5 people and you add someone who's not very good, you've got much more of a problem.
Yeah,
so.
absolutely. And I think, you know, there are one person can make a massive difference, but they can also be a massive distraction.
Yes, yeah.
So yeah, that's definitely. I mean, we didn't think too much about that in the early days. We just hired where we needed initially, but I think as we grew, we put more emphasis on that sort of area where we were more careful about, you know, personality and the mix and what we actually needed going forward and how that person might develop. Yeah. Because often the way you want to take them, they don't want to go.
So how many people do you have working in your organisation?
4.
Full-time?
Yes.
4 full-time employees. Well, you know, as is often the case, that's probably too small to be sustainable as a hedge fund.
Well, it's a question of cart before the horse, is it not? How do you pay for more people unless you have...
You pay for them out of your own pocket.
Yes.
We are based here in Cambridge, the home of entrepreneurship, and people take out second mortgages on their house to start businesses, high-tech businesses, programming businesses, biotech businesses, to get themselves to the point that they might maybe get a bit of angel money or seed money or maybe even venture capital money. You've got to take a risk. Why would I invest in your fund as opposed to just getting the newsletter and making the trades myself?
So that we could share in the benefits of our work.
Don't want to share in the benefits of the work. All I want is the newsletter, and I will just make the investment. I'll just trade. Why would I not do that?
You could do that. That would be part of the source of the alpha. But we've also configured a set of trading rules that fit and dovetail very well with the recommendations that we issue. And we don't make those public.
Okay, so as somebody, the reason I'm probing on this is you can't run two businesses. Big investors want to know that you are all in on this.
We are in a state of transition between one thing and another. We have been trialling this for many years, issuing firm recommendations, configuring trading rules and so on. And we are now ready to turn that from a pilot project into a proper fund management organization.
Okay.
However, our bread and butter, what pays the rent, is the publishing business.
Well,
and the same inputs go into both.
You're going to have to give one up. You can't run a hedge fund as a hobby.
If you put yourself sitting in the investor's seat, and I
Yes.
think it's one of the things I would suggest in you thinking through anything about strategy and building out is that you have to think about how is it going to be incorporated into an investor's portfolio. But in the main now, capital is being allocated by being able to identify on a number of other issues which we may be able to come on to. But when it comes down to how do you generate that performance and the sustainability of that performance, and is there sustainability through a repeatable process of an alpha?
Organization is, I would say, a possible problem because we are clearly in the CTA box because we trade futures. But most people think that CTA also means systematized trader. There's still a human link in the chain. And we like that, by the way. It's possible we may go fully systematized at some time in the future, but I would be uncomfortable with it.
However hard you work, and as the leader, entrepreneur, head person in a financial firm like a hedge fund, you do work incredibly hard.
Yes,
okay?
yeah.
And it consumes your life.
Yes.
And if it doesn't consume your life, you need to get another job,
Yeah,
because you're doing the wrong thing.
Yeah.
So it consumes your life. You spend 18 hours a day, 7 days a week worrying about it and thinking about it, but it's still incredibly fascinating and satisfying.
Yeah.
Is there anything that has to change within the business, if you were to get to $1 billion? Is there anything in the business today you think has to change to be able to get you to $1 billion?
Yes, we need to build up our infrastructure. In particular, a lot of the growth that we have seen is in the managed account space. I actually expected all of the money to go into the fund. In the launch process, you put all of this work into building a fund structure, and then everyone says, "That's lovely. Do you mind giving me a separately managed account?" And so, at first, it appeared that managed accounts were, that it's no different to the fund, but actually, it requires a reasonable amount of back office just to, if you're running 5 managed accounts, that's more complicated than running one fund.
Yeah.
So I think at this point, we've got the sort of asset management side reasonably under control, but it's
which you
a
should
matter
do.
of, but as you add, more clients, and particularly in the middle office space or in the managed account space, you find that you have more and more back office work to be done, and it's important to we aim to have no trade breaks and things like that for our clients, because I just don't think it's acceptable really to...
No, but you've also got to remember there's a point at which, you can do all that in-house, but you have to recognise when to not do that in-house and outsource that.
Oh, so you outsource?
We do now. We didn't. We went the route of doing everything ourselves. We had proprietary technology. We had our own. Everything was built ourselves. There's a point at which that doesn't add value to your clients, and you end up with a massive overhead, if you like, or structure that you're then having to maintain. So it's also, the trick is finding out that sweet spot where you then look for that outsourced solution.
There's a number of people that are critical. A top-notch COO is the sine qua non. If you don't have that, you aren't going to make it. Your model comes up with a trade. Who executes it?
We execute it, either Jesse or I.
So you sit at a screen and you click a button?
Yes.
That's not going to work. It has to appear like an institutional firm.
Yes.
Now, you don't have to go out and hire 100 PhDs.
Yeah.
Okay, there's no requirement to do that.
I even agree that, once you build out in the manner in which you're describing, it liberates Jesse and I to concentrate almost 100% on research, which is our goal. Our goal is never to become a multi-strategy shop. It is to run our strategy as well as we can, and as you say, that involves having everything else taken care of in a very professional manner.
What thing do you think is going to be most challenging for you when you're in the next couple of years?
Building it out, I think.
Okay.
We can easily manage, I don't know, $100 million, something like that. We're trading highly liquid futures markets. We don't use much leverage. There will be very limited market effect up to possibly $200 or $300 million. But the logistics start to become a task to accomplish.
You've got to take a risk.
As in fact I have already done.
Well, you might have
in order to get to where we are now.
You're going to have to take a bigger risk. And
well, I've just raised that second mortgage, actually.
Okay, well, that's what.
So we're doing that.
That's what you're going to have to spend.
Yes.
What are you finding to be a challenge then in terms of actually raising assets, or are you literally just building your track and sitting, trying to build that out first?
We have been building it. We are ready to expand to a commercial level because it's sub-commercial at the moment, and getting there is hard because nobody wants to be. I mean, we don't need people to be the first in, but nobody wants to be the first big one in.
No.
And
it's the chicken and egg story.
It is.
I think it is finding that first client, and probably more importantly, perhaps the first institutional client.
Yes.
Because people take a great stock in having that element within your business, or a client that's actually made that call. I think trying to go after that institutional client that would like the story, I think, and listen to you would be important.
In reality, getting to be an institutional manager is a long, long way away.
Yes, yeah.
Somebody that can get rated by pension consultants, that could be a serious contender for, a US public pension. That's years and years and years away.
Yeah.
Okay? And that you really have to be larger. You have to have all of the infrastructure. You have to have lawyers and all of those other things going on. You shouldn't think of that as the goal, but what you're trying to do is get to
get a percentage of the way there.
Get a percentage of the way there. Be a solid investment.
Yeah.
So my advice would be, get rid of the feeling of slightly odd. Well, firstly, sort out your business, put all the money behind it, go all in on the hedge fund if you want it. Secondly, sort out your marketing so that it looks a little bit more conventional. And thirdly, I mean, I'm not suggesting that you change your investment style, but I think it's going to be a hard pitch.
Despite the results?
Yep, despite the results.
It would be useful to start with Richard and HED. That was an interesting presentation, which I'm most probably being polite.
I think you're being very polite, yes.
I think what came across, though, was sadly a level of pretension and not really conveying the strength of a message. And if I'm honest, that one of the things that struck me as really very important, if you're going to come with something that is new, you're going to try and put it in a category which is not existing categories, sort of somewhere in between, then you really need to get across what is the true differentiator within that then would make it valuable.
I think it's very dangerous to arrive and say we are just so different from anybody else, we're so unique that we don't even present it in the way that you'd expect it to be. And it's not about being a nice person, but there has to be some relationship between an investor and the person they invest in. And I just really didn't get that at all.
He doesn't have the background. So he hasn't, as far as I'm aware, none of them are actually in the hedge fund industry. So, they're learning as they go. So feedback would be very encouraged, I think, on that basis.
Yes, yeah. There is a degree of that being, in some ways, humble. I'm coming with something new. We really feel that it works. We've got everything that we can display to you, the evidence, as well as our belief. But that's not what came across. The sort of blunting of that through the delivery, I thought was a very...
Well, it overshadowed everything else, really, is what you're saying,
yes.
I think, in essence.
They did get reasonable amount of facets, or they did start to add in these other products that they were talking about, because I really struggle to see how you do that with 4 people.
I understand that you can have that mix of discretion and modelling, and to some extent everyone's a quantitative manager in that they do use some models or analysis. I was just concerned that I didn't really know quite what it was. What is actually going on? When you finally get down to it, I think it's, well, this sounds very pejorative, but it feels like chartism.
There's something that exists, that Tom DeMark has created, which has similarities to, I think, the strategy. But there's nothing wrong with that. It's just be very clear about what it is, and therefore it can put you in a position that could be potentially of interest to a consultant or investor who's looking at other strategies that it could add some value to. But again, that didn't come across.
No. The time frame from we started doing this 12 years ago and publishing a newsletter, presumably, to have then waited 12 years and then decide we'll start running money. Oh, and we haven't risked any of our own money on any of these trades. And it's the beauty of futures. It doesn't cost any money to, well, modulo. I'm just not quite sure what went on in the last 12 years.
Well, if they're all scientists, though, I mean, that's the problem in itself, as you probably are aware, and that you need to have a variety of people in a business. I mean, maybe that's what
problem being a scientist.
It's not a terrible problem being a scientist, Natasha.
I work with many of them.
Yes, I am one.
Yeah, no, exactly.
No, carry on that.
Yeah, I'll keep going, shall I? I'm enjoying myself.
Do that stuff.
No, I think it's a problem, though, when they're all maybe that's what's gone on. There's a lot of academic discussion and research, and because you become intrigued, don't you, with what's going on? I mean, that's a possibility.
I mean, personally, I don't know about you. I really wouldn't touch this with somebody else's.
You're about to say I'm out.
No, I'm out. No, probably for copyright reasons, we're not allowed to do that. Have you seen the marketing materials? Now, I like reading marketing materials because it tells you something about the firm and the people. It honestly looks like it's been put together with a shovel. And if they can't sell themselves at all, then it's probably a dead end.
Have you watched any of the videos out of interest?
Oh, yes, I've watched the videos.
Okay.
Now, I know we live in a digital world, and I like digital stuff. Putting videos describing yourself on the internet just looks flaky.
Well, maybe that's a good segue as well into Patrick, because what a difference.
And the mood from this side of the fence was quite different too.
Yes, it was. I could feel it as I sat here. There was someone who came across as being refreshingly straightforward, passionate about what they did. Just wanted to convey that you really should believe me, but actually, I really do love what I'm doing. That everything I've tried to put together is, to make everyone feel comfortable, so you can focus on what I'm doing.
It definitely came across as honest and likeable.
Yes.
Which sounds, I know this is a quantitative business, but it's really important. And I also found, the marketing materials were also much clearer. Now, you didn't get a sense of the strategy necessarily, but you certainly got a sense that they'd thought through the business, thought through perhaps the roadmap.
I think Patrick doesn't really need AUM in that sense. What he needs is mentoring and guidance. He's very enthusiastic, very personable. There's clearly a few little rough edges there, not because he's a difficult personality, but because he just doesn't know what to say. He hasn't been asked the right questions. He hasn't.
But he's also not a marketeer or salesperson.
He's definitely not.
Yeah.
But he's probably not a bad person to run a business. I like the fact that he and his partner are all in.
We're back to alignment as just clear cut.
Yeah. Fully aligned. Yeah. They've been working hard on this. They must have, since he said they could run for a period of time. They've probably got a business plan. That thing that entrepreneurs do, a business plan. I'm surprised that they run at quite such a low volatility. That was the only thing I thought, is that given the potential Sharpe ratio on this, you could probably push it up a little bit more than 4% volatility. And maybe the problem has been is that the headline numbers aren't high enough because he runs at quite low volatility. I think he's probably a little bit blasé about capacity. As we know, capacity is actually a big issue, and it does get much harder to think about costs.
But I like that he'd said that written into the documentation that was the cap.
Yeah.
Because at least that implies a hard limit, as opposed. I know people can always change their minds, but the point is it's a hard limit, and he states it quite honestly. Now, I don't actually believe that it would. I think you'd have issues at opinion, quite frankly.
Oh, I think you would, yes.
But I think as an investor into it, say up to 500 million, possible.
He comes across as quite resilient to hard times. And I think that's sort of important. You figure that he will go through hard times, as we all do. But I think he'll be quite resilient to that, and will work it through, whatever needs to be done.
It's quite difficult because I think if you step back and look at the strategies, how would you compare them? Might be a slightly different take if you removed the characters and just looked. But that's not the position.
The risk is to the business, not necessarily the investment risk. I mean, certainly you've got to consider both, but that you want to invest in something that's going to be here in 5 years' time.
So, gentlemen, thank you very much for coming back. That we've had a chance to have a discussion about your presentations, about yourselves, about the strategies you're running. I'm going to start first and just go through what I've personally decided. I'd like to start with you, Richard. That it's very difficult. I do like elements of the strategy. I do find it interesting. I don't think you did it full justice today. I'm afraid that it didn't come through in terms of the presentation or the answers of what could be quite unique and quite interesting about the elements of what's embedded in the strategy. I don't feel you did yourself justice today. And that has influenced a great deal on thinking about whether to allocate to you. I do have that sort of grudging interest in the strategy, and I would like to see through the next year whether some of the elements underpinning it can work and do work. I'm going to award you $1 million. Hopefully, see that the way in which you take that strategy forward and present it can improve. Thank you. So Patrick, one of the things that stood out for you was the passion and the simplicity of your message, and I thought it was delivered extremely well. Gives a level of confidence that it's a business that can succeed as it is today, but also a strategy that I think is grounded on a very solid foundation. You may be, given the space you're in, need to think about having more confidence in your strategy and taking a bit more risk. Really came across as being very genuine, very clear, as I said, and something that I think from here we can believe has a future. And obviously, I wish you good luck with that. As a consequence, I'm going to award you $10 million, and be very keen to see how you progress through the course of the next year. So, thank you very much. $10 million to you.
Glad I'm sat here and not stood there actually. Okay, starting with you. I mean, you pretty much summed it up very well, I think. I think it's interesting. I think it sounds interesting, but I didn't really get a feel for it. I think it's tough in 2 minutes, and I think you haven't got the experience that perhaps Patrick has in the business in terms of actually presenting something to investors in the same way that you have. So I think that there's a distinction to be made there. For me, it's more about the business risk as opposed to the strategy risk when you're dealing with an emerging manager. So on that basis, actually, I would do exactly the same, and I'm going to give you $1 million. And do the same thing and monitor you and really want to see that you are thinking about the business and really the game plan and how you're going to actually message, because that's really something you have to get right. People make their minds up in the first 2 minutes. So, and it's a people business at the end of the day. Yeah, no, great. I really enjoyed it with you. You came across really genuinely honest, excited. I think, passionate is one word, but excited about what you're doing, which got us excited, because it's not necessarily a light the fire strategy in the sense it's completely out there. But it was something really, really lovely to just hear you present it in that way and understand that you've thought about the business and how you're going to go forward. So on that basis, I'm going to give you $5 million. Thank you. Thank you.
Well, I'd also like to thank both of you for the presentations, 2 very different presentations. I'm going to start with Richard. I don't really think we hit it off terribly well. And part of that is maybe a presentational style issue, but I kind of felt like I was being thought of as a bit of an idiot. Now, you may think that, and of course I may indeed be a bit of an idiot, but it's not a great thing to do as somebody who's trying to run a business, to give that impression to anybody. You need every investment you can get. Although you have something which may indeed be unique, there are very few things that are new under the sun. So it is sort of important to remember that the people sitting on this side of the process have done this before and may have some input. I'm going to award you 0. And the reason for that is I can't imagine working with you. If I can't imagine working with you, then I really am not going to invest. So Patrick, I think we hit it off better. I loved your passion for what you did. I also loved a little bit of the slightly raw edges to your presentation. The challenges for you are mostly about building your business. But I think the difficulty for you is getting from where you are now into something which is sustainable and something which is investable by larger investors and more institutional investors. So on that basis, I'm going to award you $5 million. But on top of that, Patrick, I'd like to offer you some of my time to mentor and maybe give you some advice in how you grow the business. I've been in the same place that you are in, and some luck, some skill, but managed to get a little bit bigger. So if you'd like that help, I'd be more than happy to do that.
Thank you very much.